I must share with you something I discovered in the Epstein documents. Furthermore, you must realize that what I am going to demonstrate to you is not a conspiracy theory. It isn't conjecture. The email, which was concealed among the millions of pages of papers made public by the U.S. Department of Justice, was sent to Jeffrey Epstein on a genuine date by a real person and had actual attachments. It also has to do with silver. The timing of this is crazy, so let me first give you the background. The Epstein Files Transparency Act became a law in November 2025. It mandated that all unclassified documents pertaining to Epstein and Ghislaine Maxwell be made public by the DOJ. The DOJ has published more than 3.5 million pages since January 2026. 3.5 million. These consist of flight logs, portfolio statements, FBI interview summaries, bank statements, wire transfer data, and emails. The political names in these files have drawn attention from all over the world. With good reason, they are presidents, princes, tech tycoons, and billionaires. But since that's what I do on this channel, I was looking at the financial paperwork while everyone else was searching for the well-known names. I go with the flow, and I was completely shocked by what I discovered in those financial records. For weeks now, I have been providing coverage of the silver market on this channel. Leverage flushes, supply chain conflicts, vault drains. The full thing. However, when I saw this document, I had to put everything on hold because the silver squeeze thesis in this May 2011 email is so specific, accurate, and uncannily foretelling of what is occurring in 2026 that it made every hair on my body stand up. Next to that email is a JP Morgan portfolio statement that reveals that at the same time, Ghislaine Maxwell, the woman incarcerated for sex trafficking, was purchasing millions of shares of a silver mining firm. Greetings from the hidden economy. If this is your first visit, click subscribe. I tackle topics that are not covered by the mainstream financial media. I need to know how many of you are paying as much attention to the files as I am, so please let me know in the comments where you are seeing this movie. As you are aware if you have been watching this series, I never make assertions without supporting evidence. I can prove anything I show you. Everything has a source. Today is no exception. Let me now demonstrate what I discovered. The date of the email is May 27, 2011. An individual named Bernard submitted it to an email address linked to Jeffrey Epstein. Power of Attorney Silver Centrope is the subject line. You should already pause after reading that topic line. Silver Centrope Power of Attorney in a single line. This isn't a friendly email exchange. This financial manager is discussing account management and investment strategy with his client. Bernard informs Jeffrey that he is quitting his job at Artis, a private bank in Switzerland. This isn't your typical bank. People with net worth starting at 9 figures are served by this type of bank. In order for Bernard to continue overseeing the account, he needs Jeffrey to sign a power of attorney on a financial trust by the end of the month. To put it another way, this man is so involved in Epstein's financial life that he always makes sure he can maintain control over the money even after changing jobs. That's the connection. Now, listen to what happens next. Let me repeat what Bernard writes. I have also enclosed some research I made on the silver market, and I am fully convinced that a squeeze is possible if one can take delivery of 100% of the futures contract. If 100% of the futures contract can be delivered, a squeeze is feasible. A financial advisor to Jeffrey Epstein is producing a thorough thesis in 2011 on how to physically fulfill all comic book futures contracts in order to pressure the silver market. Nor is he speculating. He contained his research. The email included information on silver firms, a PDF on CME position limitations, and an executive summary sheet about silver. This was no incidental remark. One of the most well-connected financial players in contemporary history was being presented with this organized investment concept. However, it goes deeper. Bernard goes on. He claims that the weak hands were the only ones squeezed by the 5 hikes in margin requirements. Just stop there. You understand exactly what this means if you viewed my film on the silver crash. Silver prices ranged from about $17 to over $50 in 2011. 5 times, the CME then increased the margin requirements. 5 times. The price then plummeted. Does that sound familiar? Due to the fact that silver ran from 37 to 121 in 2026. And what took place? From 5% to 8 to 11 to 15 to 18%, the margins were increased. The price then plummeted to 64. 14 years apart, the same playbook. In 2011, Bernard was able to identify it in real time. He referred to it as a mechanical liquidation, a flush of the weak hands rather than a fundamental shift. He then makes his forecasts. Without excessive guesswork, he predicts that silver will close the year at $60. He claims that $150 is the inflation-adjusted value. Additionally, he predicts that within 36 months, the gold-to-silver ratio will drop from 40 to less than 20. I must take a moment to explain the significance of these figures. Because these predictions were so radical in 2011, you might not grasp them if you're new to silver. Just now, silver fell from $50 to $32. The silver bubble had burst, according to every Wall Street analyst. Every headline accused silver investors as being naive. The conventional wisdom held that silver would return to $15 and remain there. Amidst all of that chaos, this individual writes to Jeffrey Epstein to inform him that the inflation-adjusted value is $150. He wasn't going along with the crowd. He reached a result that was completely at odds with consensus after examining the fundamentals, the supply gap, the industrial demand, the monetary features, and the mechanics of the futures market. Extreme conviction, extreme intelligence, or both are required for that. Allow me to now contextualize these forecasts for 2026. The current price of silver is $82. The mainstream ridiculed Bernard's 2011 $60 target, yet his inflation-adjusted worth was $150. From 2011 to 2026, add 14 more years of inflation to that. In today's currency, you're looking at much over $200, and his suggestion for the gold-to-silver ratio, it was 40 in 2011. The ratio is currently about 37 in 2026, with gold trading above 3,000 and silver at 82. On a longer time scale, it has been compressing precisely as he had predicted. This man was not mistaken. He arrived early. Additionally, in markets, being right and being early appear to be the same thing until they are not. The market is confirming his correctness after 14 years. This is where the narrative becomes really unsettling. And I mean unsettling in a way that makes a clear connection between Epstein's financial world and the silver market that no one has openly examined. A portfolio statement from J.P. Morgan Chase is attached to this email. Ghislaine Maxwell is the account holder. J.P. Morgan Chase requested that the paper be treated confidentially. Although it was never intended for public viewing, the Department of Justice has made it available for anyone to read. 5 months prior to Bernard sending Epstein the Silver Squeeze email, in December 2010, the paper was created. What does it display, too? It demonstrates that Ghislaine Maxwell used her J.P. Morgan account to buy shares of First Majestic Silver Corp. First Majestic isn't just any business. Listed on the New York Stock Exchange, it is among the top pure-play silver mining firms in the world. Since January of 2026, its share price has increased by more than 130%. 15 years ago, Ghislaine Maxwell was purchasing it. Not a little. In 2010, she purchased 100,000 shares on November 29th. She then purchased 3 million shares on December 6th. J.P. Morgan sold 3 million shares. While Epstein's financial advisor was putting together a silver squeeze thesis and attaching CME position limit documentation, the statement's total cost came to about $41,000. Before I show you the web, let me make sure you understand it. Epstein's financial advisor drafts a comprehensive strategy outlining how a physical delivery can enable a silver squeeze. Through a J.P. Morgan account, Ghislaine Maxwell is concurrently purchasing millions of shares of a pure-play silver mining firm. Additionally, J.P. Morgan, the bank that held Maxwell's account, was later found to have manipulated the precious metals markets and was fined $920 million in 2020. Since everything in that email is directly related to what they were actually doing, allow me to explain. Traders at J.P. Morgan were found guilty of spoofing, placing thousands of fictitious purchase or sell orders that you never plan to carry out is known as spoofing. The goal is to deceive other traders into believing that there is a huge supply or demand, which causes the price to move in the way you choose. You then take advantage of the price movement you produced by canceling the fictitious orders. For more than 8 years, J.P. Morgan engaged in this activity in the gold and silver markets. 8 years. A number of traders received personal convictions and were imprisoned. The head of the precious metals desk at J.P. Morgan was convicted of racketeering rather than securities fraud. The same accusation they employ against organized crime is racketeering. So this is the image. This is the type of thing that seems like fantasy, but it is documented in federal court documents, so I want you to really think about it for a moment. A silver squeeze based on physical delivery is being discussed by Epstein's network. Through J.P. Morgan, Maxwell purchases silver mining stocks, and J.P. Morgan uses spoofing to manipulate silver prices in order to keep them low. What would be the best course of action if you wanted to build up a sizable silver position prior to a squeeze? When you're making a purchase, you want someone to keep the price down. To accumulate as much as you can before the crush occurs, you would want the price to be artificially low. Whether it was intentional or not, these materials show precisely that dynamic. I'm not claiming that these things are related. The convergence, I repeat, is extraordinary because the Epstein files are so large, so complicated, and so overpowering that the financial ties are being obscured by the political names that make headlines. I am stating that no one in the mainstream financial media is addressing this angle. Let me now explain why this is important to you in 2026. It's not just a history lesson, after all. The silver squeeze theory, which was the subject of that email, is more relevant now than it was back then. Bernard's main point was straightforward. The market is squeezed if 100% of the futures contracts are physically delivered. COMEX had enough stock in 2011 to meet the obligations. That is no longer the case in 2026. For years, the inventory of silver registered in COMEX has been steadily declining. Vaults in Shanghai have collapsed from 1.265 to 350,000 kilo. Extreme physical stress is indicated by London lease rates of 4.5%. Because the market is in backwardation, consumers are paying more for delivery that happens right away than delivery that happens later. Not just partially but potentially, every single criterion Bernard outlined as being required for a squeeze is currently present in the data. And since I looked over Bernard's theory point by point and compared it to data from 2026, here is the portion that should frighten anyone who is short silver or watching from the sidelines. He needs to physically deliver his squeeze. Delivery notices for COMEX are currently on the rise. Rather than rolling contracts, large buyers are waiting for delivery. Margin hikes primarily benefit weak hands, according to his thesis. We simply observed it occur. 121 to 64. 39,000 contracts were canceled. However, backwardation deepened and lease rates increased throughout the crash. The physical market is more competitive than ever, but the weak hands have left. A shortage of supply is the foundation of his argument. It was a little deficit in 2011. We are currently experiencing an increasing deficit for the fifth year in a row in 2026. The demand for solar has doubled. In 2011, there were no demand categories for AI data centers, 5G, or electric cars. And his worth of 150, adjusted for inflation. Add another 14 years of inflation to that. $220 to $240 is yours. Silver is 82. Silver is currently trading at around 1/3 of fair value, assuming his research is accurate, and the directional call has been dead right up to this point. Because the exchanges cleaned out leveraged speculators and increased margins 5 times, the squeeze in 2011 failed. Although the weak hands were removed, Bernard realized that the basics remained the same. There was no change in the supply shortfall. There was no change in the industrial demand. The only positions that moved were the leveraged speculative ones. He was correct, because 14 years later, silver has surpassed his $60 goal. The basics prevailed. Simply put, they took longer than anyone anticipated. Here are some ways that 2026 differs from 2011. In 2011, small funds and retail traders were the buyers attempting to crush silver. Increases in margin could flush them. Nation-states are the purchasers in 2026. China is imposing restrictions on silver exports. Silver is categorized as a vital mineral by the U.S. The two superpowers are vying for Latin American physical supplies. Margin calls are not given to sovereign buyers. Short-term price fluctuations are of no concern to sovereign buyers. Bernard told Epstein that the secret to the squeeze was that delivery is taken by sovereign customers, except delivery of all futures. The most powerful nations in the world are currently using the technique Bernard outlined in 2011. Not individual traders. Furthermore, they have no intention of trading. They are taking this action due of the strategic importance of silver, which is needed for semiconductors, solar panels, electric cars, military technologies, 5G infrastructure, and medical devices. It is a structural demand. There is a decrease in supplies. Additionally, the players are no longer weak hands that margin calls can flush, and this is something that is mind-blowing. And this will impact you differently if you were online in January 2021. 10 years after Bernard sent the email, in January 2021, Wall Street Bets, a Reddit group, tried to crush silver. It was dubbed the Silver Squeeze. In an attempt to impose a short squeeze on comics, millions of individual traders attempted to purchase actual silver and silver ETFs. Globally, the movement gained popularity. Silver failed after briefly rising above $30. Why? The exchanges increased margins once more, flushing the weak hands because regular traders were purchasing paper silver through ETFs without accepting physical delivery. The pattern is exactly the same as in 2011. Here's what no one noticed, though. According to Bernard's email, the crunch necessitates delivering all futures contracts. SLV is a paper ETF that was being purchased by the Wall Street Bets crowd. They weren't accepting deliveries. They went against what the thesis called for. They made a mistake in their attempt to squeeze silver. Since the files had not yet been made public, the instructions on how to actually accomplish it had been sitting in Epstein's emails the entire time, unread. Today, in 2026, buyers are avoiding that error. Physical delivery is being accepted in China. Through supply linkages throughout Latin America, the United States is hoarding. The number of central banks is growing. The lesson Bernard explained 15 years ago has been learned by all. The weapon is physical delivery. The distraction is the paper. Here's one more thing that will blow your mind. JP Morgan had 0 ounces of actual silver in 2011, the year Bernard sent that email. Nothing. The Hunt brothers attempted to control the silver market in 1980, but by 2017, only 6 years later, JP Morgan had amassed more than 133 million ounces of actual silver. The government had to step in because the Hunt brothers possessed so much silver. During their squeeze, silver rose from $6 to over $50, while JP Morgan covertly amassed even more. The largest physical silver holding in modern history was being amassed by the same bank that was manipulating silver prices lower. They were using one hand to buy and the other to restrict the price. Here's why this is more important than the Epstein headline. Because the true understanding is not about a single person or email. It concerns what the ultra-wealthy think about assets based on the email. Something important is revealed when a private banker to one of the most influential financiers in history writes a thorough silver squeeze thesis and includes CME position limit documentation. Silver was being treated as a pet rock by those at the top of the financial food chain. They were researching the specifics of using physical delivery to corner the market. And 14 years later, they discovered the identical theory that sovereign nations are currently implementing. And it's no accident. It's a playbook. And because the DOJ disclosed it, you were able to read it for free. There is more to the Epstein papers than just criminal activities. They serve as a blueprint, and it's apparent what the blueprint states. The weapon is physical delivery, the fuel is a shortage of supply, and manipulating margins to flush weak cards was the only thing that ever stopped the squeeze. The feeble hands have vanished. In my previous video, I demonstrated that to you. Comics open interest fell from 176,000 contracts to 137,000. There are no more leveraged cowboys. Strong money, patient money, sovereign money, and the type of money that accepts delivery but does not sell are what are left. If you're still watching, you'll find what I'm about to lay out to be astounding when you see it all at once. So allow me to connect the dots for you. The precise method for a silver squeeze was determined by Epstein's financial advisor in 2011. Consider a tangible delivery. Ghislaine Maxwell used JP Morgan to purchase millions of shares of silver mining stocks between 2010 and 2011. JP Morgan paid $920 million in 2020 for using spoofing to manipulate the precious metals markets. JP Morgan paid $75 million in 2023 to resolve their banking relationship with Epstein. Silver was designated as an essential mineral by the U.S. in 2025. China imposed export restrictions on silver in 2026. Comics and Shanghai vaults are now empty. The cost of leasing is at an all-time high. Extreme backwardation is seen in the market. And the price of silver is $82. Even though Bernard's 2011 inflation-adjusted figure is now worth more than $200, that one email from 2011 showed every piece of the jigsaw: the target, the mechanism, and the circumstances. 14 years later, all the requirements have been satisfied, and the players have far more power than the retail merchants who made an unsuccessful attempt in 2011. Here, I want to exercise caution. Based on this email, I'm not sure if Epstein exchanged silver himself. The amount of Bernard's involvement with Epstein's financial activities is unknown to me. I'm not sure if the Maxwell share purchases were coincidence or part of the squeeze concept. I am aware that these documents are out there, the public has access to them, they were made public by the Department of Justice, and demonstrate that, as early as 2010 and 2011, the silver squeeze theory was being debated and implemented at the top echelons of private wealth management. Here's what I believe this signifies for anyone who currently owns silver. The thesis remains unchanged. It's only gotten more powerful. It works in the same way. The basics are the same for physical delivery, shortage of supply. It follows the same pattern. Strong hands build up when weak hands flush. The scale is the only thing that has changed. It was private wealth in 2011. It is sovereign wealth in 2026. When margin rises flushed the speculators in 2011, the squeeze failed. Governments that do not receive margin calls are the purchasers in 2026. I have silver. I own stakes in mining companies. I have a stake in this outcome. Furthermore, an email from the Epstein files is not the reason I am holding them. The reason for this is that the data, inventory figures, lease rates, backwardation, government acts, and yes, historical evidence, all of which show that the world's most intelligent people have been examining this trade for more than 10 years, all point in the same way. You now possess the most complete picture on the internet if you have viewed my full series. You saw the vaults draining in the first video. You saw the $300 price objective in video 2. You saw why the crash was a trap in video 3. You saw the US-China supply chain war in video 4. The silver squeeze theory is not new, as this video demonstrated. Since at least 2011, it has been in circulation at the top echelons of international finance. The only distinction is that the circumstances to carry it out are now present. Epstein files silver on Google. Go through the email yourself. Do your own research on the Maxwell portfolio statement. Check all of what I just told you. I'm not requesting your trust. I would like you to review the docs. FA01165353 is the email reference number. FA01320542 is the JP Morgan statement reference. The DOJ Epstein Library allows the public to search these. When the news cycle shifts to the next celebrity name in the files, this type of information is stored in memory, so go look at them, take a screenshot, and save them. Additionally, ask yourself one question while you were there. What do you think Epstein's financial circle, private bankers, wealth managers, and ultra-high net worth networks are doing in 2026, when all of the requirements they listed have been satisfied? If they were examining a silver squeeze in 2011 based on physical delivery mechanics, when nation-states are following the precise strategy they outlined, when, precisely as they had expected, the weak hands had been flushed. In 2011, when JP Morgan itself amassed 133 million ounces of the very metal they were manipulating, the inventory levels are worse than they could have ever envisioned. The astute investors anticipated this. They simply noticed it beforehand. The rest of the world is now gradually but painfully catching up. Leave a comment below with your opinions. If you believe that the Epstein files are solely political, forward this to them. They have to do with money. They have to do with metals. They also deal with a theory that is being demonstrated in front of us. There is much more to this tale. It's speeding up. Additionally, the Epstein files have provided us with the blueprint demonstrating that the world's wealthiest people have been aware of this for 15 years. Now that you have the information, the question is, what will you do with it? The hidden economy is this. I'll meet you in the upcoming